do have some fun economic data to share with everybody. The first one's not going to look great, but I'll kind of put some reasoning behind it. So this is the usual chart that I track. You can see, closed sales for the number of houses that are being purchased, and then the active inventory in Nashville. You can see that the closed sales is kind of going up and down, but a trend of going down. And then the big thing to note, which is not super surprising, that the number of transactions in January dropped quite a bit, which is normal. That's seasonal. In fact, you can look January 2023 and see that the same thing happened. So it's more of a monthly trend rather than I don't think it's going to continue. So when we get the February numbers, that'll be very interesting. And the inventory is just kind of slowly creeping up pretty consistently. So when you have closed sales going down, inventory going up, I think prices will stay stagnant, maybe potentially fall a little bit. And that's what I've been saying consistently, but the prices have trickled up. So I've been wrong there, but this is what I'm looking at. And then the metric to follow here is months of supply. So that is just based off the inventory in the market, how many months would it take to purchase all of those homes based off the number of transactions happening. And as you can see in January, the number of transactions fell quite a bit. So the months of supply is quite high. Now, again, January of 2023 was when it jumped up as well. So it went from 3 to 4 last January, and then went from 3 to 5 this January. So I think January is kind of an outlier. We'll see how the trend looks February and March, but these are my favorite things to track. So that is there. And then I'll try and blow through these charts just because I think this is fascinating. One thing to look at is the quality of mortgages that are happening in housing in general now compared to 2008. So this is mortgage originations by credit score, and you can see in 03, 04, 05, 06, the lower credit scores were gold and blue, and there was a much higher volume of loans being made to low credit scores versus 23, 24, 22, 21, very, very low credit scores, or a very, very high, very small amount of loans being given to low credit scores, where there's a large amount of loans being given to high credit scores. So the point of that is to say that there's a high quality borrower that's getting these loans. So that's one chart. The second chart is, this is loans and their current loan to value. So the dark blue is the number of loans that have lower than 60% loan to value, meaning that they have a low leverage loan. So the lower the leverage, the lower the risk. So I think it's 73% of homeowners have a loan to value less than 60%. So if you combine that, we've got high quality loans made to borrowers with high credit scores, and then a majority of those loans are low loan to value, meaning low risk. And then lastly, I'm flying through these, it's just mortgage delinquencies and foreclosures. So the blue is 30 to 60 day, the yellow is 90-day delinquent, and then the red is in foreclosure. So again, yeah, since 2021, it has slowly crept up. It started to come down a little bit, but if you compare it to where it was in 2002, we're still below 2002, 2004 levels. So, in hindsight, we're a good spot. So try to do this quickly and run through these. I think these are all interesting. And I would summarize of just the debt markets are very strong, meaning people are paying their mortgage, the loans are made to quality borrowers, and there's not a tremendous amount of delinquencies and foreclosures. So anything to add there, Brandon?
I love it, man. I love all the data and the insights. So thanks for sharing that.
Absolutely. Well, we appreciate everyone tuning in, and we'll see you all next month.